Is the British pound teetering on the edge of a major downturn against the US dollar, or could this be just the calm before a rebound? That's the burning question on traders' minds as we dive into the latest pound sterling to US dollar insights from UOB Group's FX experts, Kwek Ser Ling and Peter Chia. Their analysis suggests that while the pound might nudge back toward a key level, a deeper plunge isn't on the horizon, yet. But here's where it gets controversial. Are we underestimating the pound's resilience, or is a bigger sell-off brewing that could shake up markets? Stick around as we break it down step by step, making complex Forex concepts easy to grasp even for beginners. First off, let's clarify what we're talking about. Forex trading, or foreign exchange, involves currencies like the GBP, pound sterling, and USD, US dollar, fluctuating in value based on economic factors, news, and market sentiment. Support levels are price points where buying interest might kick in to prevent further declines, acting like a safety net. For instance, imagine you're at a stock market game. The support is where everyone rushes to buy, stopping the price from crashing. In pound sterling to US dollar terms, the analysts are pointing out that the major support at 1.3100 is probably out of reach right now, but a retest of 1.3120 could happen. And here's the part most people miss. Despite the pound's ongoing negative bias, short-term oversold conditions, meaning the currency has been sold off so much it might be due for a bounce, could lead to some stabilization before any further weakness. Looking at the 24-hour snapshot, the pound took a sharp tumble for 2 days straight on Wednesday, only to bounce back strongly. Just the day before, the experts predicted that the rebound from those oversold levels indicated the GBP wouldn't weaken much more, likely consolidating between 1.3140 and 1.3245. But reality had other plans. It slipped lower to a 1.3117 low. Still, with oversold signals flashing, there's potential for a retest of 1.3120 as a precursor to recovery. Crucially, that elusive 1.3100 support? Unlikely to be tested soon. On the flip side, breaking above 1.3200, with a minor hurdle at 1.3175, would signal the end of the decline, for now. This setup reminds me of how athletes hit a wall during a marathon. They might slow down, but a quick recovery often follows if they're not completely exhausted. And this is the part most people miss. Zooming out to the 1 to 3 weeks view, the outlook has been bearish on GBP since early last week. On October 30th, with the spot rate at 1.3195, the team noted the negativity but questioned whether hitting 1.3100 was feasible in this weak phase. Sure enough, it dropped to 1.3117, yet those deeply oversold short-term conditions suggest caution. They'll stick to the negative stance as long as GBP stays below 1.3245, which was a strong resistance at 1.3285 yesterday. For beginners, think of resistance like a ceiling. Prices struggle to push through it without strong momentum. But here's where it gets controversial. Some traders might argue that the pound's ties to Brexit and UK economic data could fuel an even steeper fall, potentially challenging those support levels sooner than expected. Is UOB Group's cautious approach too conservative, or are they spot on? What do you think? Should investors brace for a pound sterling to US dollar slide below 1.3100, or is this a buying opportunity in disguise? Share your thoughts in the comments. I'd love to hear if you agree, disagree, or have a counterpoint on the pound's future.